In our strategy, we work with a 5-phase cycle framework. We are not predicting headlines. We are tracking pressure, sequencing, and confirmation as the cycle evolves. Housing is one of those systems that tends to reveal stress early. This conversation highlights a late-cycle contradiction. Policymakers want home prices to stay high. They also want payments to feel affordable. That tension matters more than any single headline. We are reviewing a Milk Road macro conversation on the U.S. housing market. The discussion focuses on affordability, mortgage mechanics, and policy limits. They go deeper into the plumbing than most. Our role is to translate that into our strategy lens. The central claim is straightforward. Lower mortgage rates alone will not fix housing affordability. Prices are too high relative to incomes, and transactions remain frozen even as rates move. To restore broad affordability through rates alone, rates would need to fall to extreme levels even lower than what we saw during the pandemic boom. That is not a realistic or stable path. Policy is not inactive here. Government-backed entities are already supporting mortgage markets. That compresses spreads and nudges rates lower, but sales activity has barely responded. This is a classic late-cycle pattern. Policy shows effort, but outcomes do not change. That is delay, not resolution. Our strategy treats those very differently. When prices stay high and transactions stall, cost pressures shift elsewhere. Insurance, taxes, and fees rise. Fixed-income households feel that stress first. The discussion points to likely next steps: more subsidies, more nonprofit and institutional programs, support for builders to keep prices elevated. Those actions can slow adjustment, they can stabilize headlines, but they also suppress real price discovery. Imbalances build quietly underneath. The key issue is supply, not just demand. Inventory exists, but at prices people cannot clear. When transactions restart, supply does not arrive gradually. It tends to arrive all at once. Ideas like longer mortgages sound helpful, but they stretch payments without fixing affordability math. They increase lifetime cost. Again, delay rather than repair. Assumable mortgages already exist in limited programs. Scaling them would require major servicing changes. Portable mortgages go further. They break the securitization engine entirely. Housing liquidity comes from securitization. Loans are tied to specific properties. That structure is what keeps rates lower than they otherwise would be. Break it, and credit tightens fast. In our strategy, this fits late phase 1, moving into phase 2 pressure. Prices stay high. Activity stays frozen. Stress accumulates beneath the surface. This raises the probability of housing becoming a later cycle amplifier. It increases sensitivity to labor and credit confirmation. It does not imply an immediate collapse. Quick note here, this is educational macro commentary only. It is not financial advice. We watch inventory growth, builder incentives and effective price cuts, delinquencies and insurance-driven cost shocks, and transaction volume, not just prices. If this kind of framework is useful, subscribing helps you stay anchored to signals instead of noise. Each episode is built to show what is changing, and just as importantly, what is not. Policy delay remains the near-term base case. Housing does not clear in isolation. Rates alone do not solve structural affordability gaps. Housing does not need to crash to matter. It only needs to stop functioning smoothly. We do not need to be early. We just cannot afford to be late.